In this video, we move beyond simply preparing financial statements and focus on how they're structured and classified. Classification helps users and analysts quickly assess liquidity, profitability, and risk. And lenders, investors, and managers all rely on this structure to make decisions. Two companies with the same net income can look very different once their financial statements are classified. Just a reminder, the starting point for the preparation of the financial statement in a manual accounting environment is the worksheet. And here's the worksheet for Whiteside Antiques, the example our textbook uses. The worksheet is the bridge between bookkeeping and financial reporting. And once adjustments are complete, the worksheet becomes the source for every financial statement. Errors here flow through all statements, which is why accountants rely heavily on this step before classification begins. In practice, though, when you're working for a company, you would likely use accounting software to record adjustments and print out or export an adjusted trial balance. However, in this class, you're learning the manual process for accounting, and we'll use the worksheet because it teaches you what the accounting software will do for you in the future. A classified or multi-step income statement separates operating activities from non-operating ones. This allows users to see whether profit comes from core business operations or from one-time or non-core business events. It starts with the operating revenue section, and in this section of the financial statements, we enter the revenue earned from normal or core business activities, which is $549,150 for Whiteside Antiques. For a service business, operating revenue would be the service revenue that the company earns from providing services. A merchandising company would report as operating revenue the revenue it earns from selling merchandise. Just a side note, other income related to non-core or one-time events is shown separately near the bottom of the financial statements. Examples of other income include income from interest, rent, and gains resulting from the sale of fixed assets. The classified income statement continues with the cost of goods sold section, which only applies to merchandising and manufacturing companies. We start the cost of goods sold section with the beginning inventory of $52,000, add the net delivered cost of purchases of $325,120, and subtract the ending inventory of $47,000 to arrive at cost of goods sold of $330,120. After subtracting cost of goods sold from sales, we arrive at gross profits on sale of $219,030. And gross profit becomes a key amount that helps analysts understand the company's pricing and costs. Frequently, investors and analysts calculate the gross profit percentage, which for Whiteside Antiques is 40%. $219,030 divided by $549,150. This represents the markup of the merchandise. Put another way, for every 60 cents the company spends on merchandise, it generates $1 in sales. Or said a different way, every sales dollar results in 40 cents of gross profit, which must be large enough to cover all other operating expenses and leave profit for the owners. Which brings us to the next section, operating expenses, which are typically grouped into selling and general and administrative expenses, often called SG&A. These costs help generate revenue but do not directly create products. Tracking SG&A trends helps managers identify inefficiencies and cost creep. Looking at only 1 year is not always helpful, and many businesses tend to compare year over year and quarter over quarter expenses to understand what is happening to the business from an expense perspective. Whiteside Antiques spends over 30% of revenue and 77% of its gross profit on SG&A expenses. That's significant. And looking at some of the expenses, for instance, tells us that the salespeople cost nearly $80,000 in salaries, plus payroll taxes and benefits. But each $1 in sales salaries generates less than $7 in revenue. It is difficult to tell whether that is good without having something to compare it to, like a prior year for this company or a company in the same industry where the financial statements are publicly available. Net income from operations reflect the profit from normal or core business activities after subtracting the SG&A from the gross profit. Investors will want to know whether core functions are profitable and as a percentage, how much is left from all sales dollars once all expenses are paid. For this business, we calculate that net income from operations is 9.3% of revenue. In addition, investors will want to know if the company operates the business efficiently by calculating as a percentage how much the business spends on operating expenses. For this business, we calculate $167,833.80 divided by $549,150 equals 30.6%. And of that, 17.3% for selling expenses and 13.3% for G&A expenses. We don't really know whether 13.3% is high or low unless we compare the financials for this period to a prior year, the forecast for this year, or to another company in the same industry. After adding other income and subtracting other expenses, we arrive at net income. For Whiteside Antiques, other income and other expenses are very small, but watch out for financials where non-core income and expenses are significant. You will want to understand why these non-core amounts are so large. These often provide condensed income statements when applying for credit or sharing information externally. These statements provide enough information to assess performance without revealing detailed cost structures. It is common for companies to provide financial statements, especially if they're applying for credit terms with vendors. That means that you must provide financial information about your company, but do not want to disclose all the details, such as how much rent the company pays and how much you pay in salaries. You might be disclosing more than you want to. You don't want to give an outsider the roadmap for running your business. In those cases, it might be enough to provide a condensed income statement. A condensed income statement provides the minimum necessary information, but not more than that. In this case, the net sales, cost of goods sold, selling, and general and administrative expense totals, and then net income from operations, other expenses or income, and finally, net income for the year. Statement of owner's equity explains why equity changed during the period. It links profitability and owner behavior directly to equity growth or decline. For sole proprietorships and partnerships, this statement is especially important. The next step after preparing our classified income statement and the statement of owner's equity is to prepare the classified balance sheet. Just like we grouped our income statement by categories, revenue, cost of goods sold, selling and operating expenses, we group categories of assets and liabilities. Assets are classified based on how quickly they can be converted into cash. Listing current assets in order of liquidity allows users to assess short-term financial flexibility at a glance. Current assets consist of cash and items that will normally be converted into cash within 1 year, and items that will be used up within 1 year. Current assets, which are $98,716 for Whiteside Antiques, are vital to the survival of a business because they provide the funds needed to pay bills and meet expenses. Non-current assets or long-term assets consist of plant and equipment. For Whiteside Antiques, they are $31,900. Companies also often use a category called Other Assets, where the company lists assets that don't fit into the other categories. Whiteside Antiques does not have any other assets, which means that current and long-term assets combined equal $130,616. Liabilities are grouped by when they must be paid. This classification helps users understand solvency and short-term risk. A company with strong assets but overwhelming current liabilities may still face cash flow trouble. Current liabilities are debts that must be paid within 1 year. They're usually listed in order of priority of payment. Management must ensure that funds are available to pay current liabilities when they become due in order to maintain the firm's good credit reputation. Whiteside Antiques has $46,036.80 in current liabilities. Long-term liabilities are debts of the business that are due more than 1 year in the future. Although repayment of long-term liabilities may not be due for several years, management must make sure that periodic interest is paid promptly. Long-term liabilities include mortgages, notes payable, and loans payable. Whiteside Antiques has no long-term liabilities. And then the next section on the balance sheet is owner's equity of $84,579.20 for Whiteside Antiques, which combined with its liabilities equals $130,616. Once statements are classified, ratios become meaningful. Classification of the financial statement information helps us compare similar categories across companies and time periods. And each ratio answers a specific question: profitability, ability to pay bills, reliance on debt, or operational efficiency. Public companies rely heavily on classified statements to ensure transparency and comparability across industries, and analysts depend on consistent classification to evaluate trends and risks. The financial statements, analysis, and ratios are available on sites like the Wall Street Journal, Yahoo Finance, or other finance sites like Finbox. Classified financial statements don't just organize numbers, they shape how decisions are made. Understanding classification prepares you for ratio analysis, auditing, and real-world financial evaluation.